Welcome back to Prof G, Section 4's weekly podcast. I'm your host, Scott Galloway, helping you break down winners and losers in the world of business and just generally be more awesome. That's right. You want to run with the dog. That's okay. You got to watch him. You got to sneak into the big dog park. You got to take some notes. Don't see him looking at you, though. Eye contact among dogs is reason for violence. Violence amongst dogs. No idea where I was going with that. Today, we're going to break down some of the recent news out of the financial services industry. Jesus Christ, I'm bored all fucking ready. Can't we do better than that? Fire the writers, especially the ones from Harvard. Anyways, last week, Charles Schwab, Chuckster. If you haven't noticed, I'm overly caffeinated. But anyways, Charles Schwab made a big announcement.
Charles Schwab is getting rid of commissions on all U.S. equity and ETF trading. Feels like this was a long time coming.
By the way, that is Scarlett Fu from Bloomberg, who is a really wonderful woman. I've been on every business news program in the world, because I'm kind of a big deal. And you get a sense for the hosts. And most of them wait till break and then just check Twitter to see who's talking about them or scream makeup. She is, however, incredibly impressive, intelligent, and a really nice woman. Anyways, less than 24 hours later, E-Trade and TD Ameritrade followed suit. And yesterday, just 10 days later, Fidelity made the same announcement. This is big news. Why? Because these companies register substantial revenues from commissions. Last year, commissions accounted for 6% of Schwab's revenue, 16% at E-Trade, and almost a quarter, 24%, for TD Ameritrade. Finally, Fidelity is not publicly traded and doesn't release these numbers. Oh, Fidelity, you're so sexy. You're so coy. Anyway, some analysts were particularly upset by the move.
Riddle me this. Why the heck would you give something away for free if you could charge real money for it instead? I know a lot of people were asking themselves that very question yesterday when Charles Schwab, the big online brokerage house, announced they were getting rid of commissions on certain kinds of trades.
I love Jim Cramer. I actually think he has an incredible breadth of knowledge, and there's very few people on television that make me feel reasonable, young, and handsome. All three companies saw their market value decline in the face of declining revenues. Charles Schwab's market cap declined 16%, E-Trade was down 18%, and TD Ameritrade, get this, lost nearly a third of its market capitalization on this news. So this is a learning moment. Why? Because these companies lost a greater proportion of their market capitalization than the share of revenues that they shed. Now, what does that mean? That means one of two things. Either the market believes these companies won't be able to variabilize their costs down to match the decline in revenues, so profitability will take an even bigger hit than the one registered by their top-line revenues, or the markets see this as a change or an indicator of a larger disruption occurring at the hands of innovators. In other words, is this industry about to be Netflixed or Amazon? The brokerage market is certainly ripe for disruption. The entire financial industrial complex is aging out. The clients of these big players, including E-Trade, Fidelity, and Schwab, are getting older, much older. Less than half of all traffic to Charles Schwab, E-Trade, Fidelity, and TD Ameritrade is from consumers under the age of 34. And it's the same across industries focused on finance. The average age of a CNBC viewer, get this, 67, which doesn't sound weird until you realize what the term average means. That means if someone is 30, accidentally flips on CNBC, that means someone 104 is watching. I mean, effectively what we have here is catheter television, and if you looked at the ads, it's catheter television defrauding seniors.
Looking for real-life answers to your retirement questions? Get real, get started. Talk to Chuck.
Trade like Chuck. Yes, there's proprietary trading method that Chuck has figured out, so you too, you 94-year-old, can spend more time with your grandkids if you just send Chuck $49.95, and he'll show you how to beat the market on CD-ROM. Yeah, that's legitimate advertising. Anyways, he should run that on Facebook. It's probably a conspiracy involving Hunter Biden. There's my political humor brought into Prof G. Anyways, there's been a lot of limited innovation here as a function of concentration in the market, which suppresses innovation. There's really only 4 legacy players. The process of making trades has remained largely unchanged and static for decades, and it's a complex process that requires a lot of education. They're essentially a series of multiple operating systems, and each have their own user interface and quirks. I've used Schwab, TD Ameritrade, and Northern Trust personally. I found Schwab by far to be the best with really good customer service. I don't know if I was used to the interface or my sense is they have more capital. In a past life, I've actually helped build websites, but my sense is the UI is a little cleaner, a little bit more response. The back-end engine is a little bit more robust. TD Ameritrade, I have not used, or wait, I have used TD Ameritrade. I just said that. Wait, no, I didn't use TD Ameritrade. Jesus Christ, drunk again. I've used Interactive Brokers. The reason I use Interactive Brokers is their core competence is they offer the lowest margin rates, which really isn't a competence. It just means you're trying to buy business, but it appears to have worked for them. That was literally the Joey Bag of Donuts trading platform. I mean, it was terrible. It was designed by my 8th grade son. I don't have an 8th grade son, but if I did and he smoked a lot of marijuana and his friend who worked at TD or Interactive Brokers asked him to design their website, I think it would look something like that. And then Northern Trust feels like what it is, a company that has not made the requisite investments in online. Are you listening to me, management of Northern Trust? Get your shit together, seriously. I don't know if you've heard about this thing called the internet, but it's really powerful. It's really powerful. So consumers don't love their products. Charles Schwab has an okay Net Promoter Score, 52, but TD Ameritrade and E-Trade's NPS scores are terrible. TD Ameritrade's registers at 16 or comes in at 16, and E-Trade is -6. The disruptors have already emerged to take on these giants. And who are they? Enter Robinhood.
Robinhood, it's a mobile app that lets users trade U.S. stocks and ETFs without any commission fees.
Doesn't it sound like that person is talking to your grandfather? Seriously. So Robinhood, it's a mobile app, which means it comes on your phone, Grandpa. Anyways, Robinhood has been mentioned a lot this week following the announcements around zero-fee trading because no free trades are core to Robinhood's business model. The company has allowed consumers to trade without fees since it was founded in 2013. So this firm is a credible threat to Schwab, Fidelity, E-Trade, and TD Ameritrade. The firm's raised $862 million at a valuation of $7.6 billion. And has registered an estimated $69 million in revenues last year. So let me get this, 100 times revenue. So Robinhood, I think you're awesome. I think you're wonderful, and you are ridiculously fucking overvalued. And be clear, last round valuations are a bit of a headache because the person in a private investment or the investor gets what's called a preferred, meaning that if it's sold in the private markets, they get their money back first. So there's some downside protection. So that money is a bit illusory. And if it goes public, those preferences are typically wiped away, but it typically won't get public, and those investors won't let it go public unless it goes out at a higher valuation than the one they invested at. So it's a bit of a, I don't want to call it a one-way option, but that number, what's a head fake about that number is it doesn't really indicate a real number in a trading market. And what a lot of private investors, specifically the unicorn industrial complex, have tried to do is to convince the market that, oh, in fact, that number is a real number. And they release that number and act as if the company is worth that. And if it's growing, it must be worth more. And hey, you fucking idiot retail investors, you must be willing to pay this number, and we'll hire an investment bank to get an analyst, a smart equity analyst, to basically lie and say, this isn't chicken shit, it's chicken salad, and overestimate all the growth prospects and then try and foist it on retail investors. If that sounds cynical, it is, and it's also true. So there's a lot to unpack about Robinhood and their business model, but that, my friends, is a separate podcast. Oh my God, I'm being coy. I'm teasing you like Mickey Rourke in 9.5 weeks, only not as good looking, not as talented, and much, I think I'm younger than Mickey Rourke. Robinhood has been able to attract the exact consumer that Schwab, Ameritrade, and E-Trade have struggled to hold on to or to capture. The average Robinhood customer is 32 years old. That's actually very impressive. Think about that. That means that effectively CNBC's kids are on Robinhood, as far as I can understand it. Or viewers of CNBC, their children are on Robinhood. And 54% of the company's website traffic comes from consumers under the age of 34. So that, first off, advertisers, businesses, all love young people. Why? Because as it would make sense, young people are the future. Their disposable income is going to grow, and they're generally just harder to attract. So there's always a premium, whether it's advertising rates or valuation placed on consumers, on young people. If you look at the ratings for shows, they always break out kind of their under 40 viewership. And CNBC and other places actually brag. CNBC brags that 20% of the viewership is under the age of 40. Wow, that's impressive. So Robinhood has attracted these consumers by targeting the vulnerabilities of the financial industrial complex. Their app and site make trading easy. The company's app is ranked 12th in the iOS App Store. It's got a nice UI, feels very elegant, feels much kind of hipper, fresher, newer. E-Trade, Charles Schwab, and TD Ameritrade's apps are all ranked below 60 in the iOS App Store, which is strange because you think they'd be able to hire, I don't know, Work & Co. or Barbarian Group or, name the latest cool place where all the Brooklyn kids that drink Pabst beer and have beers are working at. You think they'd be able to buy cool online, but they haven't been able to so far for whatever reason. The company's also focused on educating their younger users about investing in a way that actually resonates with their consumer set. Traffic to its online educational content is up 180% in the last 4 months. Robinhood isn't just winning with young consumers, they're winning with a lot of them. In May 2018, Robinhood became the 4th largest brokerage firm by number of accounts, passing E-Trade to sit behind Fidelity, Schwab, and TD Ameritrade. However, that's a bit misleading, as Robinhood, in terms of total assets, is dramatically behind all of those firms. The race to win younger consumers isn't over yet, though. 43% of millennials don't invest with any brokerage firm. That's a massive base of consumers that these legacy brokerages are fighting to capture. Why are they not investing? Probably because they saw their parents lose a lot of money in the market. Probably because we have affected a tax policy and social policies that do nothing but transfer money from young people to old rich people, so maybe they don't even have the money to invest. By the way, every tax law, every lobbying group is basically doing one thing, and that is figuring out a way to take money from young people and give it to the wealthiest generation in history, baby boomers. But I digress. There's another learning moment here. While Schwab's decision meant short-term losses for them and their competitors were forced to follow suit, I think this decision was smart, or at least inevitable. Eventually, all these companies were going to need to transition to a younger clientele, and because the company that has achieved that today, Robinhood, is offering no-fee trades, they needed to match that. So Schwab, in my view, was smart to make the leap as opposed to this dog nipping at its ankles, and then they wake up one day, similar to a lot of industries, and find that it's not a dog but a great white shark, and it's got your entire torso in its mouth. Plus, there's evidence they've been preparing, that is Schwab, for this move. The company has decreased commissions as a share of its revenues from 21% in 2009 to just 6% in 2019. They're taking a short-term loss for long-term gain, which is necessary and smart. Who else is doing this? Where else is the Empire Strike Back? Walmart, who has convinced their board, which is basically the Walton family and the Seven Dwarves, to gather around the fire, hold hands, and make staggering investments in e-commerce and take a hit to earnings. Because I present to a lot of boards, again, reference see above, kind of a big deal. And they always ask one question, Scott, how do we compete with Amazon, Apple, Facebook, Google, or whoever is disrupting them? And the majority of industry is now being disrupted by one of these players. And they think I'm going to spread some sort of magic pixie dust on the table and use the word innovation and brand or identify some great unlock. And the answer is the one they don't want to hear. And that is they're going to have to take their profit estimates down and make substantial incremental investments in the customer experience to match the firepower that these companies are offering consumers with cheap capital funded by venture capitalists and growth investors, or even the market that is drunk trying to find or chasing the high of trying to find the next Google, Amazon, Facebook, or Apple. So let's move on to predictions. Albert Einstein said, "I never think of the future. It comes soon enough." Well, I'm not Einstein. I have his absent-minded demeanor and his terrible hair, just minus about 70 IQ points. So me and Al, anyways, we're going to return to an old prediction on May 11th, 2018. I predicted in my No Mercy, No Malice newsletter that Spotify stock would double in the next 12 to 24 months. Why did I make this prediction? At the time, Spotify had explosive growth. Revenue grew 52% between 2015 and 2016 and 39% between 16 and 17. Monthly average users grew 35% between 15 and 16 and 29% between 16 and 17. It also had recurring revenue. 44% of Spotify's 170 million monthly users were paid subscribers. In addition, the music streaming service accounted for 36% of premium music subscribers globally. In addition, Spotify had network effects. Every time you use Spotify, grouping songs into playlists, your music pops into your friends' feeds, giving them ideas. Spotify gets better, making it what I refer to as a Benjamin Button firm, and that is the firm ages in reverse. Most firms, as you use them when a car drives off the lot, When you open or twist the cap off of toothpaste, it immediately declines in value. But the firms that have registered the greatest growth, the Googles of the world, the Netflixes of the world, get better. They age in reverse as they are used, which is sort of a fancy way of saying network effects, but I think it's still an apt metaphor. All of this is still true, but instead of doubling over the last year as the dog thought was going to happen, Spotify stock has declined by 12%. Today, it's down 27% from when I made that prediction. So I got this wrong, sort of 27% in the wrong direction wrong. Spotify's a great company, but it has a major weakness, or we have a major weakness as an economy, and that is it's competing with an unregulated monopoly. Specifically, much of Spotify's decline happened after Apple unveiled its new Apple Music service. Apple, who has a billion pre-installed base, can send updates for their app store late, can charge Spotify a 30% tax. In sum, Apple is a monopoly suppressing innovation, and Apple is now growing their inferior music service faster in the U.S. than Spotify, which is the exact symptom of a monopoly that needs to be regulated or broken up. So this leads to my next prediction. Apple will launch the Ultimate Rundle, my term for recurring revenue bundle, in 2020, which will likely, in terms of the stock market, hammer Netflix more than any other stock. I think Netflix will actually likely decline, or the stock will decline in 2020, just because of the sheer amount of capital that's coming for their lunch, whether it's Disney or Apple Plus, or what I believe will be one of the most powerful recurring revenue bundles, and that is the Apple Rundle. This bundle of goods will likely include Apple TV Plus and Apple Music, which is gangster, but in my view, they should go big time and include Arcade, Apple News Plus, and Apple Care Plus. 420 million people subscribed to one of these Apple services last year. That's right. That would be, I think, the third or fourth largest nation in the world. Spotify only has 108 million premium paid subscribers, and Netflix has 150 million subscribers. So overnight, the Apple Rundle could be the dominant Rundle in the world, maybe with the exception of Prime. This would be gangster, as Apple's profit margin has declined over the last 2 quarters. This would also give Apple Prime-like characteristics and make it a serious player in the streaming wars. Ladies and gentlemen, it's office hours with Prof G. Remember that if you want advice from the dog, you can send a question on Twitter or go to hashtag ProfGOfficeHours or shoot us an email at officehours@section4.com, or leave us a voicemail if you want to go old school, if you watch CNBC, at 646-667-6627. By the way, that thing where you check out Kim Kardashian and sext that girl you met last night, or that guy, that's probably a hate crime. That is also a phone. You can use your finger and call your mom, and she will answer and talk to you. Okay, on to our first question from Brian in Morristown, New Jersey.
Hey, Scott, how you doing? I'm just wondering where you think the cannabis industry in the U.S. will be in, say, 3 to 5 years. Do you see it being legalized on the federal level? And, from a business perspective, or from a stock perspective, have you given thought as the best way to play the industry? Thanks a lot, man.
That dude sounds kind of groovy. I'd like to roll with that guy. That guy feels like the kind of guy that we should smoke something and go surfing with him and just hang out and have some Mexican food. Okay, so this is a complicated issue. From a legislative standpoint, I think the green wave is overwhelming Washington. It is ridiculous that we have made marijuana illegal. I don't think it is nearly as bad for you and nearly as disruptive to society as alcohol has been, for example. I have some personal experience here. When my mom was struggling with cancer, the only thing that gave her relief from her incredible nausea was marijuana. And it was 2003, and I had trouble finding marijuana. And I didn't want to travel with it on a plane, and ended up on the streets of Las Vegas trying to score marijuana, which I did not like doing because I thought I could get arrested, and it just felt really strange, such that my very sick mom could feel less nausea. But what I found is that you can only have drugs if you pay a shit ton for them, and some pharmaceutical executive has decided to molest you. That drugs of the most powerful and addictive sort are absolutely available as long as it goes through your HMO. But anyways, the green wave is coming. A ton of people smoke marijuana. It's not like anything, like any vice, obviously it's key in moderation, but I'm not here to lecture you about your drug use or lack thereof. So in terms of an investment, my sense is I would stay away from the space, and I don't know it very well. Marijuana stocks have taken a huge hit right now, but this is a highly volatile sector, and I think it's overinvested because essentially every Republican billionaire wants to buy a sports team, and every Democrat billionaire either wants to buy a newspaper or invest in marijuana stocks. Because obviously it's going to be a growing market, but I think there's so many regulatory concerns. There's so much overinvestment. I just think it's incredibly volatile. If you were going to play the space, I would try and find out what their infrastructure plays are, because I think there's going to be such a massive investment in the space that will likely require whatever the supplies are. I'd want to be the Schlumberger, not the front end here. But I would stay away from cannabis stocks, not because I'm not a huge fan of legalized marijuana and think it will give a ton of relief to a lot of people, but because it's an incredibly volatile sector right now that I think has been overinvested. Okay, and our next question, speaking of marijuana, is from a caller in San Francisco.
What's your opinion on buying and holding Tesla stock? I know you're long short on Tesla, but I was actually reading your other linked article that points to the Dina valuation, who actually values the stock at $180 by the year 2023, which is about $50 shy of its current valuation. So I just wanted to kind of get your opinion on the current valuation of Tesla and see if it's a stock that somebody like myself can buy and hold. Thank you very much, and have a great day.
All right, thanks for the question. So I'm not certain if the stock's going to go up or down. I have a viewpoint, but what I am certain of is that if I dare mention that the stock might go down, about 1 million Twitter handles with no identity will come after me and say that I can't do, so I teach, that I'm ugly, that I have no credibility. If you want to incite the ire of people and have a really thoughtless discussion, just try and talk about Tesla stock and suggest that it may go down. It's like nothing else. A lot of people would say that points to their passion or their evangelism. I think it creates an unhealthy dynamic in the stock. So look, first off, you said you're short the stock. I don't short stocks. One, because I talk a lot about stocks, and I don't want to ever be accused of trying to talk down a stock in the short term. And B, I think you really need to be a pro to short stocks. I think you should short stocks only to hedge or leave it to the pros because it's expensive, and you just hate to have a clock or a gun cocked against your head. And also, personally, I just don't like betting against something. I write a lot about companies that I think are overvalued, but I think there's a role there because I think you're saving retail investors from a lot of pain if you point out kind of the other side of the argument as opposed to the 99% of the unicorn industrial complex that is there just to pimp these things. So Tesla, why do I think it's overvalued? And I'm about to go on Barron's TV, which, believe it or not, is a thing, and they will ask me about Tesla. I think it's overvalued, and I do think that the stock is probably headed lower. Why is that? First off, let me acknowledge I own a Tesla Model X, and I love it. I think it's a great product. I think it's a great brand. But I think this market has the key feature of an industry that is not disruptible, and that is it is a well-run, low-margin, large business. It's largely consolidated, and I think what they have done with Tesla is incredible, similar to what Tucker did, the auto company founded by Jeff Bridges. Dreamy! Hello, Dreamy! But Tucker went out of business because it was hard to bump up against companies with larger scale. I also believe that, and to Tesla's credit, the German and Japanese manufacturers have been woken, and to a lesser extent, Detroit manufacturers have been woken from their electric slumber. If you look at the numbers here, it trades at an exceptional tech-like valuation, and it's not a tech company. They bend steel and they make cars, which is a difficult, low-margin business. Their margins have decreased, and their growth has declined dramatically. Their growth, I believe, in 2018 was around 80%, and their growth this year is going to be around 15%. Elon Musk is a genius who continues to overpromise and has lost, in my view, so much credibility, whether it's 1 million autonomous taxis that were going to be on the road from Tesla. So in 4 months, there's going to, I guess, 1 million Teslas are going to start picking us up. I don't think that's going to happen. Almost every metric he has put out there, or prediction, has not manifested. And in general, I have a bias against Tesla, and you have to take this with a grain of salt because as someone who's been on boards, as someone who thinks corporate governance is important, the corporate governance here is just a shit show. A board that does nothing but show up every 3 months, collect a check, have dinner, and try and figure out what Elon thinks and get there first. They clearly are just kind of his bitches. And I mean that in a non-sexist, like total fucking spineless, lax sack people who aren't doing their job and serving as fiduciaries for shareholders. When a guy commits blatant market manipulation, saying he's taking the company private at 410 or 420, and then mocks the SEC for fining him, clearly nobody on the board has any control over this guy. I think he said some ridiculously slanderous things about people he doesn't know. I think all of that stuff catches up to, and I want to be clear, I think the guy's a genius. Anyone can land 2 rockets concurrently on 2 floating barges is a genius. But I do think that sense of hubris and poor corporate governance comes back and haunts shareholders. Also, there's a decent amount of debt on this company, and if you look at acquirers, the only companies with the balance sheet to acquire this company are Mercedes-Benz and Toyota, and I don't see that happening. I guess it's a possibility, but it would be a huge pill for them to swallow. And then so people say, well, a tech company would take it, would buy it. But the problem is a tech company doesn't want this because it has a large revenue base because it's an automobile manufacturer and low margins, so if Google or Facebook acquire this thing, it takes their margins way down and probably structurally reduces their market cap by 50 or 100 billion because for the rest of time they have to report margins that are 200, 300, 400 basis points less, if you will. Everyone says Apple could acquire them. Apple's a mono brand. If Apple acquires them, you lose kind of 2 key assets. First, Apple has one brand. It's a master brand architecture schematic. It's not like Google or Facebook with multiple brands. In addition, it would just be such a culture clash. Tim Cook is humble, thoughtful, and has worked his way through the corporate America scheme. And Elon Musk is none of those things. So you'd probably lose the brand, lose Elon Musk. So I just don't see Apple acquiring this thing. So I don't think the natural acquirers are out there. It could be a go private at a much lower price. I think there's a lot of debt here. So is the question, has Tesla changed the world for the better, or will the equity get crushed here? I believe the answer is yes. Today, I want to go back to where we started this podcast and talk a little about investing, specifically the importance of investing early and often. Whether it's Susie Orman or every finance class you take, if you put $100 away every month at the age of 23, you end up with a shit ton of money when you're 65. And that is great advice because as a species, we're terrible registering time, or we don't understand the proportion of time. And trust me on this, the next 30 or 40 years is going to go like an instant. So as hard as it is to take $100, $200, or if you're blessed and have a great job, $1,000 a month and put it away, just in case you don't end up being Jay-Z or Steven Schwartzman, you'll know that you have a serious bank. Einstein was supposedly said the most powerful force in the universe is compound interest. That's not true. Someone else said it. But if I gave you a magic box and said, okay, boss, if at your age over the next 3 years you can put $10,000 in there, and in 30 years, which will go by in an instant, you can have $500,000, how much would you put in that box? And you have that box. Low-cost ETFs, put money away early and often. Unbelievable return. The same holds true for relationships, and that is making small investments of yourself every day in relationships, text messages, reaching out, expressing admiration, telling people how important they are to you, making yourself vulnerable, sharing things such that you can create more intimacy, being in touch with your feelings. When you care for somebody, expressing that affection in physical ways, and I think affection is vastly underutilized, especially among men. We're afraid to hug each other. I think the society has taught people that men who are affectionate, that it's either a signal of weakness or that you're trying to use it for sex. And so I think it's important that men take back affection, which is probably another podcast. But I would say my biggest regret in my life is that I didn't invest more in relationships when I was younger. I was very selfish, totally focused on me, and generally my only objective was to be awesome and rich, and didn't invest as much as I should have in relationships, and kind of woke up at the age of 40, didn't have a family. I had good friends who had put up with my bullshit, but I didn't have the depth and breadth of relationships that make up a meaningful life. There really is no substitute. We live in a capitalist society. You need to be economically secure, but above a certain limit, the key to happiness is a broad range of deep and meaningful relationships across work, family, and your friends. And it is shocking how much small investments, which I started making in my late 30s and early 40s, pay off. So make those investments early. Push the limits of your comfort zone. Tell people you love them. Be good to your parents. express admiration and affection, and everyday small investments pay off just hugely later in life.
I'm so tired of being alone. It's been 10 while, so all I've known.